going on, guys? Welcome back to the third and final video in this series. In this video, I'm gonna go over a very super basic strategy. It's actually a strategy I used myself when I was doing trading. I had my first $700 day. So this strategy is very easy to use. Any beginner can really use it. And it's a good introduction just to show you how powerful confirmations are, even though they're actually not that complicated. So let me just dive right into it. I will share my screen. Boom, here we are. All right, so I'm gonna go over just a little bit of review, things I touched on in the last video, and clarify some points that I didn't in that video. So let's talk about lots. So like I said, one standard lot represented by 1.00 is worth 100,000 units. So it doesn't quite equate to 100,000 US dollars or 100,000 euros. We're dealing with a lot of different other currencies. So to keep it simple, it's referred to as units. We have a mini lot, which is 0.10, which is worth 10,000 units, so approximately 10,000 US dollars, not quite. And then we have a micro lot, which is 0.01, which is equal to 1,000 units. All right, so there are some dangerous nicknames that are thrown around a lot. The standard lot 1.00 is often referred to as a dollar lot. It's not worth $1. In fact, it's worth more close to $100,000. We have the mini lot referred to as a 10-cent lot. It's not worth 10 cents. It's actually worth closer to $10,000. Then we have the micro lot, which is commonly referred to as a penny lot, which is actually worth closer to $1,000. So let's just get this out of the way. Never use these terms. You'll thank me in the future. Again, yeah, 1 cent does not equal 1 micro. 1 micro is worth more close to $1,000. All right, so let's talk about your equity versus your margin. Your equity is your deposit plus your profits. So if you open up an account and you deposit $100, your equity is now $100. Now let's say you close a trade and you profited $3, your equity is now $103. Your margin is a little different. Your margin is your equity times your leverage. So in the last video, I showed you how we had 1 to 500 leverage, or 1 to 100 leverage, or 1 to 50 leverage. This is what I was talking about. So if you have, let's say, $100 in your account, $100 equity, and you have 50 to 1 leverage or 1 to 50 leverage, your margin is now $5,000. That's just $100 times 50 your leverage. So you want to use your margin as more of a supplement, not a drug. Over leverage makes you hemorrhage. So that means if you have $100,000 available to you, even though you only have $1,000 in equity, don't use up that whole $100,000 because you'll lose all your money just like that. But if you're smart with it, you can grow your account faster than you would without the leverage, but you're doing it safe enough to where you're not blowing your account. So it's all just about finding the balance, finding the equilibrium in your trading style. So let's talk about oscillators. This is again how I had my first $700 day. Prior to this strategy, I'd only made like, 10, 20 bucks in a day. So this is what really started to upgrade my trading. So what do oscillators do? They identify the trend. They show, okay, it's an uptrend or it's a downtrend. They show overbought or oversold conditions, which basically means, hey, price has been going up way too long, or hey, price has been going down for way too long. And they also identify reversals, which means, hey, I think this downtrend is moving into an uptrend, or I think this uptrend is moving into a downtrend. So that's what identifying reversals means. Which ones are beginner friendly? So it's kind of funny, most oscillators are very, very beginner friendly, then there's a couple that are not. So I'm gonna cover a few oscillators that are very, very beginner friendly. These are the ones that I personally used 3 years ago when I was first getting started. We have moving averages, MACD, and Stochastic. So these are 3 I'm gonna go over today. And I'm gonna show you how you can use these 3 oscillators together to enter in some trades. All right, so moving averages, it's an indicator that smooths out price. It's considered a lagging indicator, which means the data it shows is slightly delayed. So that's both a good and bad thing. It's a bad thing because we want the most current, fresh information we can get, It's a good thing because it's been out there for a while. So traders have already figured out how to use it. And that's what I'm gonna teach you today is I'm gonna teach you how to use it even though there's a lag. So basically what a moving average is it takes the average of the past few candlesticks. So let's say you have a moving average and you set the moving average to 9. It's going to take the average of the previous 9 candlesticks. Or if you set it to 21, it's going to take the moving average of the past 21 candlesticks. So that's what they do. There's 2 types of moving averages that we're going to use today. First one is called a simple moving average. Second one is called an exponential moving average. They're very similar, but I'll cover the slight differences they have. So SMA and EMA, that's how we abbreviate them. SMA, simple moving average. EMA, exponential moving average. EMAs is similar to SMAs, except more weight is given to the recent price data, which just means EMAs move faster. They're closer to the current price than the SMAs. So like I said, how they're lagging, EMAs lag slightly less. SMAs are smoother and give less false readings, which means a little slower. So that's the yin and yang, the strengths, weaknesses, pros and cons. EMAs are faster, but give you more hiccups, more false readings. SMAs are slower, smoother, and give you less false readings. So when we use them together, we can get the best of both worlds. I like to compare EMAs to vodka. It gets the job done nice, fast, and hard, but you might run into some errors. You might make some decisions you regret. I like to compare SMAs to a nice, smooth wine. It gets the job done a little slower, but smoother, and there's less chance of you making a fool of yourself. All right, so how to use moving averages. The setup I like to use is this. I like to have a simple moving average set to 21. I like to have an exponential moving average set to 9. So when the EMA is above the SMA, that means price is in an uptrend. And when the EMA is below the SMA, price is in a downtrend. So right here, we have an example of an uptrend. The red line represents the EMA and the blue line represents the SMA. We can see that the EMA is above the SMA, indicating that price is an uptrend, and we can visually verify that by just seeing that price has steadily been moving up. So here's an example of a downtrend. We see that the SMA is below the EMA is below the SMA, indicating that price is in a downtrend. And again, we can visually verify that by seeing that price is moving down. So the most useful way I personally like to use moving averages for is the crossover. When the EMA crosses under the SMA and price is under both MAs, that means you should sell. And when the EMA crosses over the SMA, price is above both MAs, that means you can buy. And I'll show you what I mean by that. So right here where it says sell here, we can see that's right where the EMA moved under the SMA, telling us it's a good time to sell. And then we close that sell position when they cross over again. And we close that for 200 pips, which is $2,000 if you're trading with a standard lot, $200 if you're trading with a mini lot. So let's look at another example right here. Right where it says buy here, we can see right before that, the EMA crossed above the SMA, indicating that there is reversal or an uptrend. We ride it all the way up until it says take profit, where we can see the crossover again, which we close for 300 pip profit, which again would be $3,000 with a standard lot or $300 with a mini lot. Boom. So now on to the next thing. It's called MACD, which is very, very similar to the moving averages. In fact, it stands for moving average convergence divergence, which, what do we care about? We care that it identifies a trend. We care that it displays overbought and oversold conditions. And we get a little more advanced to care more about convergence and divergence. I'm not going to talk about in this video. That's a little more advanced. So if you're curious about that, we can do it with further research. Anyway, how do we use the MACD? We're going to look over for crossovers, just like we do with the moving average. So right here, where it says buy, we can see that the MACD just crossed over. And when we see take profit, we see it cross over again. We close out for 300 pips, which again is $3,000 for a standard lot or $300 for a mini lot. Here's another example. We see where it says sell here, the MACD crossed over in a bearish way. Then we take profit where it crossed over in a bullish way. Take that 250 pip profit. That's $2,500 with a standard or $250 with a mini lot. All right, so the last indicator I'm going to go over is stochastic. Stochastic is a little less useful than the last two, but when you use stochastic with these two, it becomes very useful. So stochastic, it identifies overbought and oversold conditions, which basically tells you, okay, it's been going up for way too long, which means it's a good time to sell, or it's going down for way too long, which means it's a good time to buy. It does not identify the trend, which is why it's basically useless on its own, but that's why it's also useful when you use it with other indicators. So the way you use it, if you see the lines above 80, it means overbought. If it's under 20, it's oversold. Stochastic complements other indicators. Like I just said, never use it without any other confirmations. In fact, when you're using any indicator, any confirmation, any strategy, make sure you have multiple confirmations backing up your thoughts, backing up your guess of which way it's going to go. Never take a trade based off of one confirmation. You want 10, you want 15, you want 20 confirmations for your trade so that you know that you're not going to make money and you know that you're going to be consistent with your trading. So, but in this video, I'm going to show you how to use 3 together, and this is how I actually have my first $700 day. So we can see where they all line up, where it says buy here. We can see that the moving averages crossed over. We can see that the MACD crossed over. And we can see right before this crossover happens, the stochastic was way oversold, which told us it was a good time to buy. So the stochastic was first telling us, hey, it might be a good time to buy. Then the moving averages and the MACD caught up, again, because they're lagging indicators, saying, hey, I agree. Then once all 3 of those indicators agree with each other, we enter in a buy. And then we buy, we take it up to where it says take profit, we close that when things cross over again, and we just made a few $1,000 just using 3 confirmations. Here's another example. Right where it says sell here, we can see that the moving averages crossed over. The stochastic right in the middle right here was overbought right before it happened, again, giving us a warning signal that sell might be coming up. Then we can see right at the bottom, the MACD, it crossed over, time to go down. So we have our 3 confirmations. Price goes down where it says take profit. That's where we close. We made a quick 250 pips. It would have been $2,500, which I don't know about you, but an extra $2,500 a week would really help you out. That's rent, that's food, that's groceries, that's a movie, that's a date night. So many things right there. All right, so that's pretty much it for this video series, guys. Thank you so much for watching. If you have any other further questions, you can reach out to me. You can reach out to the person that's sending you this video. Again, I'm just sharing this video because I found Forex 3 years ago and it absolutely changed my life for the better. And I just want to hang out opportunity to you. So if this is something that you're interested in, please get back to either me or the person that's sending you this video, or if you found this video on your own, you can do your own research. That's how I learned. There are faster ways of learning. It's best to learn with a community, with people who are both learning, with people who've been trading for years, and with experts. So it's best to find a community full of traders. And that's what I like to do, and that's why I'm making this video. So again, guys, thank you for watching this video. I hope you learned something from this. And if you're interested in Forex, I highly recommend you research further into it. It changed my life, and it can change yours.